Hi there, my name is Greg Laxton and I'll be highlighting a few key aspects of AVI's 2018 financial year-end results. We arrived at our recommendation based on the following. Despite AVI being a high-quality company with attractive operating margins, a consistently good return on equity, and historically healthy cash generation, there are concerns over the operating environment looking bleak in the short term, which translates to muted volume growth and negatively impacts the recovery of fixed factory costs. The group has a strong portfolio of brands, which are largely defensive, and strategies to mitigate margin pressures have proven effective. However, the sustained currency weakness is likely to have adverse effects. Although the weak rand is good for the fishing business, it negatively impacts the beverage and footwear divisions due to the import cost component. Improving margins will thus become more difficult to sustain, as the weak economic conditions will lead to a fight for market share in a saturated market. We feel that AVI is fully valued, trading at a forward PE of 17.8 times, which is slightly ahead of its longer-term average, and hence we retain our underweight recommendation. Looking at debt, net debt decreased by 12% to 1.27 billion. The net debt to EBITDA ratio was lower at 0.43, which is well below the covenant ratio of 2.5. The interest coverage ratio improved 29% to 20.1 times. The weighted average cost of capital increased to 12%, and the return on invested capital increased to 26%. The economic value added remained relatively flat at 14%, indicating that investments are generating sufficient earnings to recover the cost of capital used. Looking at earnings, revenue increased by 1.9% to 13.44 billion. Adjusted operating profit increased 7% to 2.5 billion. And operating margin increased 90 basis points to 19%. Diluted headline earnings per share increased by 7.2% to 540 cents per share. The final dividend declared was up 7% to 260 cents per share, while the 8% increase in the interim dividend to 175 cents per share translated to a full year dividend of 435 cents per share, which is an increase of 7%. In addition, the board approved a special dividend of 250 cents per share. Looking at the company's prospects, the trading environment is expected to remain difficult in the next financial year, with the ongoing job losses in both the private and public sectors likely to further dampen consumer spending. Management expects that many of the group's categories will produce low or even negative growth rates until there is a meaningful improvement in the economy. A good portion of the new financial year's import requirements have, however, been covered at rates that support good levels of profitability. Management is confident that AVI remains well positioned to compete effectively, prudently manage fixed and variable costs, and be alert for acquisition opportunities both domestically and regionally. Our portfolio guidance is as follows. The current capped SWIX weighting of AVI is 0.72%, and our recommended portfolio exposure is 0%. Before I end off, if you would like to trade, then please contact our trading desk. Investors are reminded that they can refer to our online trading platform, which contains a more in-depth analysis on AVI's 2018 financial year-end results. For more information on how to interpret a trade idea, visit the events section on psg.co.za to access previous trade ideas and how to understand the method of analysis we use. Lastly, I would like to bring your attention to the following disclaimer. Thank you very much.